Hey everyone, this is your weekly market outlook for the 7th to the 11th of November 2022. My name is Vito Henjoto, and let's get this started with a recap of what's been going on last week. So we've got the FOMC hiking rates by 75 basis points. Now this is in line with market expectations. FOMC is also expected to reduce the size of future hikes, which is also in line with market expectations. The surprise comes from Jerome Powell's comments that they are actually far from near, hinting that the terminal rate is much higher than what the market has been pricing in. With this comment alone, it changes the market's expectation of a more dovish FOMC to one that remains extremely hawkish and determined to fight inflation. Now this is again in contrast with what Bank of England has been doing. So Bank of England also hiked by 75 basis points, which is the highest in 30 years, but comments from Bank of England Governor Bailey indicates that the terminal rate is actually lower than what the market has been pricing in essence turning Bank of England into a dove, and that's why we see a little bit of a drop on Thursday. But then we have the US employment data that comes in a little bit mixed. We've got the NFP gaining 261,000 versus expected 200,000. Wages also higher at 0.4% month on month. The downside to these great numbers is a jump to 3.7% on the unemployment rate from 3.5%. The expected jump was actually just to 3.6%. So this is a huge jump on the unemployment rate, and that's basically what's really taking the dollar down despite the hawkish FOMC comments. So it has been a little bit of a roller coaster week as expected. Good thing was that the UK autumn budget was pushed back to the 17th of November. Otherwise, we would be expecting a much crazier week last week. All right. This week, a couple of key fundamentals to go through earlier in the week. So we've got the Eurogroup meetings on Monday. We've got the UK, German, and US bond auction. This is going to be on Wednesday. Now, we are going to pay closer attention to the bond auctions because of how the bond market has been affected in the past 2 months, especially the UK bond market. And we've got the US inflation numbers coming in on Thursday. So with all CPI numbers in the past few months, we all know this is going to be another roller coaster week. But this one here on the month-on-month CPI, we are expecting a little bit of a gain from 0.4% to 0.6%. Expecting a decrease in core CPI month-on-month from 0.6% to 0.5%. Although the forecast range could actually potentially see an increase to 0.7% as well for the core. Year-on-year CPI expected to drop from 8.2 to 8% and 8.1% range. Expected range is still going to be below 8.2%. So we'll see if there's any upside surprise on these year-on-year CPI. This is going to trigger a much stronger US dollar here. But again, if it comes in as expected, and even if it drops down below 8%, then we might see the US dollar likely going to be a lot weaker. We might see a little bit of a gain on the Euro USD and the Pound USD as well as the Aussie USD. Year-on-year core CPI expected range is actually between 6.5% to 6.7%. The current year-on-year core CPI is actually at 6.6%. So in terms of range, it might be 0.1% lower or it might be 0.1% higher. So this is a little bit more in line with the month-on-month core CPI numbers as well. Then we've got UK GDP numbers expected on Friday, as well as the UK industrial production and manufacturing production numbers. That's going to wrap up the week this week. All right, so let's take a quick look at the dollar index here. Now, at time of recording, we are looking at a huge drop on the dollar index here. Market opens at 113. We are looking at a drop to 111. Overall, this is still within the Ichimoku cloud. In terms of key support, we do still have that 110.50 and then 110 for the dollar index support. Now, in terms of momentum, it is rather flat at this point in time. So we'll see what happens here. Again, US CPI numbers expected to be more of a volatile trigger for the market this week. So we'll see if the numbers are actually going to be better than expected. If it does and inflation remains hot, then we are likely going to be looking at a potential stronger dollar here. All right, yields on the other hand, this is pretty stable. So this is probably a much better indication of what the US dollar strength is likely going to be. So while the dollar index we are looking at a huge drop on the yield here, we are actually looking at just a flat stable movement here around 4.2%. This is still higher than 4% key level. In terms of key support level for the yields, we still have 3.5%. Now this does give a strong indication in terms of a potential for a stronger US dollar. That is still possibly in view, although it's going to be highly dependent on what that CPI number is going to be for the US market. All right, next up is gold. So we do see a little bit of a run on gold here on Friday. That's basically just on the back of the mixed numbers from the US employment numbers there. But again, key levels remains the same in terms of key resistances. We are still looking at key resistance around 1695, 1700. That's going to be in range until about 1725. Right now, it is trading within the Ichimoku cloud in terms of pivot. For the week, we have 1660. That's also the key level, pretty much at around 61.8%. In terms of support, we do have 1640, 1645. Immediate resistance to the upside for now, it is going to be at 1695. But where we are trading in terms of gold, it is actually around 1675. So we might actually see a little bit of a pullback, potential pullback towards 1660, and see how it goes from there. All right, so calendar-wise, pretty clear on Monday. A lot of medium impact news, but nothing really major. Comments from ECB President Lagarde. This is pre-recorded, so I don't think it's going to have a huge impact here. The Eurogroup meetings throughout the whole day. You might see some information trickle in regarding how the European economy is growing. So we'll see how it is on Monday. On Tuesday, again, we have a few numbers here. We've got the New Zealand inflation expectations, not really major. We've got the RBA Governor Lowe speaking. Again, probably not major. I think the major key event for Tuesday is actually going to be the US congressional elections. But I don't know how it is going to impact the market directly in terms of political changes there. This is for election for Congress, right? On Wednesday, we've got the Chinese CPI numbers and PPI numbers. This might affect a few Asian currencies, especially in the Asian sessions. We might see the dollar get affected as well during the Asian sessions. But other than that, we're not really looking at major events going on. We've got the bond auctions. This is going to be on Wednesday. We've got the UK bond auctions. We've got the Germany bond auctions. We've got the US bond auctions. That's scattered throughout the day. This is likely going to be focused by a lot of traders to see how it goes. All right, on Thursday, pretty much ignoring all the other numbers, we are going to focus on the US CPI numbers. All times as per calendar is actually at GMT 00, so adjust to your timing accordingly. US CPI numbers, again, month on month, expected to see a little bit of a drop to 0.4%. CPI year on year, CPI month on month, expect to see a little bit of an increase to 0.6%. The year on year or the headline inflation numbers expected to drop from 8.2% to 8%. Core CPI monthly expected to drop to 0.5%. Again, in terms of range of forecast, it's actually going to be at 0.5% to 0.7%. So be a little bit more careful here. Changes in, if we see a drop in the headline inflation numbers, but if we have the monthly CPI numbers and the core goes up, that's going to overrule a lot of the stuff there. All right. So on Friday, we've got the UK GDP numbers. A few holidays. We've got Armistice Day in France. We've got Veteran Day, I believe, in the US. So be a little bit mindful in terms of liquidity. It might dry up a little bit on Friday. All right, jumping on to technicals. So the Aussie USD, the pair is basically traded back in range after a volatile week that saw the pair traded lower towards the 63 key support level. Key technical level remains the same as the market returns to 64 cents pivot, indicating a new range between 63 to 65 cents. Strongest support is to be expected at 62 cents, while key resistance remains at 65 with 65.50 and 66 as the next barrier for the pair. Underlying trend remains downtrend as the pair remains traded below the Ichimoku cloud. That's for the Aussie USD. So Sideways market condition is still to be expected for the Aussie USD. That seems to be the case for a lot of the currency majors here. So we've got the Euro USD, we've got mixed US data that has sent the Euro higher, saw the pair trade back within the Ichimoku cloud. It actually picked out a little bit above the Ichimoku cloud, but the market does open down closer to 99. So the market does gap down and opens the day at around 99 cents. Very, very close to the weekly pivot. Now, considering the volatility in the market, it's too early to determine a change in the underlying trend. No divergences were detected and momentum remains rather flat. So we've got the stochastics, the blue line, that's still really, really flat, just slightly below 50 there. Expect the pair to be traded close to the weekly pivot at 99 cents with parity as resistance and 97.50.98 as the base of the range. Now this is likely going to be the case leading up to the US CPI numbers. Okay, similar situation with the pound USD. So the pound USD on the cable here, we've got the potential trend transition that was observed last week. That remains in view as the pair bounces off 78.6% Fibonacci retracement on Thursday. Following the hawkish comments from the FOMC and more of a dovish stance from the Bank of England. It does bounce back up a little bit on Friday, bounce off 78.6 on the back of that mixed US employment numbers. So at the point of recording, however, the pair is actually traded within the Ichimoku cloud while momentum still points to the downside. This actually opens up a possibility for the pair to be traded sideways this week, leading up to the US CPI data on Thursday and UK GDP numbers on Friday. Weekly pivot remains anchored close to 1.14. Key level with key resistance higher at weekly resistance 1 around 1.16. Key support remains in 1.15 to 1.12 range. So keep that in mind. This is trading within the Ichimoku cloud. All right, next up, finally, we've got the dollar yen. And nothing much has changed, so let me just give you a quick short update on this one. Nothing much has changed in terms of key technical numbers here. We've got that whipsaw happening in the volatility last week. That pretty much brings it back to neutral. So the pair remains actually traded above 145 key level with likely pivot right now at 147. Last week was actually at 147.50. So we're not really too far off from last week's pivot. Resistance remains at 150. The pair could remain traded close to pivot awaiting the US inflation numbers this week. Should the inflation come in lower than what the market expected, then the pair will likely retest 145 and possibly 143 support level. Now, if a hot inflation number comes into play, this could drive the pair close to 150 psychological resistance. The pair is also expected to remain trading within 145 to 150 range this week. Market remains cautious of potential Japan Ministry of Finance intervention again should the pair move higher than the 150 key level. So again, I'm sounding more like a broken radio by now, but that possible intervention at around 150, that's still going to be at the back of every trader that trades the Japanese yen. All right, with that, good luck with your trades, and I'll see you soon.